Ever wonder how those giant private equity firms just seem to find absolute gold mines where the rest of us just see, well, a regular company? You know, it's not magic. It's really a playbook. And today, we're going to walk right through their 5-point inspection plan to see exactly how they spot a winner.
So let me start with a question for you. What could a typical house flipper, the kind you see on TV, possibly have in common with a massive, multi-billion-dollar private equity firm? The answer is actually pretty simple, and it unlocks their entire strategy.
It all comes down to this. They both hunt for hidden value. A house flipper looks for a property with good bones, right? Something that's a little undervalued, maybe needs some work, that they can fix up and sell for a nice profit. Well, private equity firms do the exact same thing. It's just that their fixer-upper is an entire company.
All right, so how does this hunt for value even begin? Well, the very first step for any PE firm, just like for that house flipper, is checking the foundation. And in the world of finance, that foundation is a company's cash flow. And it has to be strong and, just as important, predictable.
But why is cash flow so critical? Because that cash flow has to pay the mortgage on the whole deal. See, here's the thing. PE firms almost never buy companies with just their own cash. They borrow huge, massive amounts of money to finance the purchase.
This whole strategy has a name. It's called a leveraged buyout, or an LBO for short. The leverage here is all that borrowed money. It's a really powerful tool because it lets the firm buy a huge asset with a relatively small down payment. Now, the brilliant and, pretty risky part is that they plan to use the company's own future earnings to pay off that loan. Let's just map this directly back to our house flip analogy, okay? First, the PE firm gets a huge mortgage. That's the debt. Second, they buy the house. That's the company they're targeting. And third, they use the rent, which is the company's cash flow, to pay off that mortgage. If that rent isn't steady, the whole investment could fall apart.
Okay, so a solid foundation is absolutely essential. But let's be real. It's not enough to make a profit. Just like our house flipper, a PE firm needs a crystal clear renovation plan. And this brings us to points 2 and 3 of our inspection, figuring out exactly how they're going to create new value through improvements and growth.
This really gets to the heart of the private equity model. These firms aren't passive investors who just buy and hold on for the ride. No way. They are active owners. They get their hands dirty to fundamentally improve the business, making it leaner, more profitable, and ultimately way more valuable.
And here's what that fix-it plan usually looks like. If a company's operations are a bit clunky and inefficient, they'll come in and streamline everything to cut costs. If sales have gone flat, they'll push hard for expansion into new markets or maybe develop new products. And here's a popular one. If the company's in a fragmented industry with lots of little players, they might use it as a platform to buy up smaller competitors and build a much bigger, more powerful company.
But even the best renovation plan in the world can fail if it's in a bad neighborhood. And that's exactly why PE firms look at points 4 and 5, two super important external factors. The location, which is really the industry itself, and the leadership, the talent that's actually running the show.
I mean, think about it. You wouldn't want to flip a house in a neighborhood where property values are plummeting, right? It's the same idea for private equity. They want to invest in a good neighborhood, an industry with really favorable trends. That means a growing market, demand that isn't going to disappear when the economy gets shaky, and maybe some powerful tailwinds from new technology or changing demographics. It's like a safety net that also gives you a clear path for growth.
And finally, every single renovation needs a great contractor. Private equity firms don't actually run the day-to-day operations themselves. They provide the capital, the strategy, the big picture, but they absolutely rely on a strong, competent management team to execute that plan and make it all a reality.
Okay. So we've checked the foundation, we've gone over the renovation plan, and we've sized up the neighborhood and the contractor. Now it's time for that final walkthrough, where we put all these different pieces together.
So here it is, the final inspection checklist, breaking down everything we've talked about into 5 key points. Number 1, the foundation. That's that predictable cash flow. 2 and 3 are all about the renovation plan, clear potential for improvements, and a blueprint for expansion. And finally, 4 and 5 are about the environment. A great neighborhood with strong industry trends and a reliable contractor. That's your expert management team. If a company can check all 5 of these boxes, well, you've probably got a winner.
When you really boil it all down, it's a very disciplined formula. PE firms typically aren't out there hunting for risky, early-stage startups. They're looking for stable, mature companies that are already good, but have a clear, actionable path to becoming great. They're looking for those undervalued assets they can polish into real gems.
So now you have the playbook. You have the lens that a private equity investor uses to see the world. And that leaves me with one last question for you to think about. What hidden value is just waiting to be unlocked in the businesses all around you?